But let's do a single best chart for both of these wizards. Gabriela, let me start with you. This is the VIX, but this is a look back to 2007, 2012. And your reality, Gabriela, is I'm here, I'm fat, I'm happy, I'm green, green, green. Life is great. 2010, not as bad, but it's there. How do you prepare people for Matthew Rothman's ugly world of volatility? How do you prepare people for the sudden correction or bear market to come?
Well, we tell them that volatility is normal. If we look back to the VIX, may be a bit of a complex topic for some of our clients. So if we just look at corrections in the market, right? Yeah. Going back to 1980, usually there's a correction of 10% once a year, 5% once a quarter.
Right.
We prepare them. We tell them that's absolutely normal. It doesn't mean the beginning of a bear market. It may just be temporary headlines, a temporary correction, and then the market returns to fundamentals. And if it's a positive picture, you can end the year still in positive
on the
territory.
black swans, black swan once a century, whatever it is. Come on, we're having a black swan once every 6, 7 years. How do you respond to Taleb's classic book? Are we fat-tailed?
Absolutely, we are fat-tailed. If you think that returns are normally distributed, you're
taking the CFA.
You're sadly mistaken. Events and crashes do happen. If you're a quant, what you try to understand is what are my exposures and where am I going? Where am I going to get hurt? But you definitely shouldn't ignore the fact that returns are fat-tailed.
Gabriela, are there too many, or is the proportion of hedge funds in the markets kind of distorting the realities?
I mean, in our view, we stick with the fundamentals, right? We look at earnings, we look at economics, and that's what drives our investment allocations. And when we talk to our clients and they worry a lot about volatility, one thing we point out to them is that there's a danger of not being invested. There's a danger of trying to predict the black swans too early, of not being invested, right? If you are, let's say in the last 20 years, invested in the equity market, you would have gotten 8% annual return a year. It helps you to grow your money, helps you to achieve your goals. If you were worried about black swans and volatility, you were out of the market, your return would have fallen to 2% a year. So there is a real consequence of not being invested, and that's what we try to point out to our clients.